Viewers at home, you are welcome to my presentation on capital structure decision using betas in project appraisal. Please, if this is your first time of coming across my channel, you will see the red subscribe button. Please go ahead to click it. Beside it, you will see a notification bell icon. Please click it so that you'll be notified each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. So, what do you mean by beta? So, if you have watched my presentation on capital asset pricing, I said beta is used to measure the systematic risk. Beta is used to measure the systematic risk. I said systematic risk is the risk that cannot be diversified away because it is the risk that affects the market as a whole and all investments in the market in the same way. Then this beta, we are going to categorize it into two. We have the asset beta, assets beta, and equity beta. Asset beta and equity beta. Asset beta, so when a business, we have asset beta when the business is all equity financed. So we have business risk. When the business is faced with only the business risk, that is when it is ungeared company. When the business is all equity finance, then asset beta will be appropriate. Therefore, equity beta. So equity beta is used for a geared company. We use equity beta for a geared company, meaning that anytime you see an equity beta, you know that the business is geared. So that means the business is faced with both the business risk and financial risk. When the business is geared, that means the business is faced with both the business risk and financial risk. That is for geared company. Meaning that anytime you see an equity beta, you know that the business is geared. The business is geared. So, now, I want to explain the asset beta. What do you mean by an asset beta? Asset beta. Asset beta reflects purely the systematic risk of the business area. It reflects purely the systematic risk of the business area. That is the beta factor for a company's business operation. Asset beta is the beta factor for a company's business operation. Asset beta can also be called unlevered beta or ungeared beta. Asset beta can as well be called unlevered beta or ungeared beta. The second one is equity beta. I've told you that equity beta is the appropriate beta for a geared company. Meaning that when you see an equity beta, you know that the business is geared. But when the business is all equity financed, that is an ungeared company, asset beta will be appropriate for an ungeared company. But for geared, then equity beta will be appropriate. Equity beta reflects the systematic risk of the business area and the company's specific financial structure. Equity beta reflects the systematic risk of the business area and the company's specific financial structure. It is the beta factor of a company that allows for both business risk and financial risk. Equity beta is a beta factor that allows for both the business risk and financial risk. Then that is beta. Then how do you decide the appropriate beta? We'll be using the terms geared and ungeared. Geared and ungeared, or degeared. Degeared means to remove the impact or effect of debt. When you degeared a beta factor, that means you want to calculate, you want to remove the impact of debt finance. When you remove the impact of the debt finance, then that means you'll be left with equity finance. You know, since the business is financed with the composition of both the debt and equity, when you remove the debt component, then you'll be left with equity. When you degeared a beta, then you'll be left with equity beta, the beta of an equity company, which is the beta of asset. The beta of asset, that is asset beta. Asset beta. I've told you that asset beta is used or is appropriate when the business is faced with only the business risk. Asset beta is for a company's business operation. So you use asset beta for all equity financed company. So when you degeared an equity beta, then you arrive at an asset beta. But when you reject an asset beta, then you arrive at the equity beta. I've told you that asset beta is for an ungeared company, while equity beta is for geared company. Asset beta is for an ungeared company. Ungeared company, while equity beta is for geared. I may use the word degeared or ungeared. Degeared means is the same as ungeared, whichever term you hear from me. So both mean the same thing, either degeared or ungeared. Then when you regear, you arrive at the equity beta. So please take note of that. Now, how do you decide the appropriate beta to use when estimating the cost of capital? How do you decide the appropriate beta to use in estimating your WACC or your weighted average cost of capital? You know, you will use your WACC in evaluating the project. So now remember, I want you to take note of this. Determination of the appropriate beta. Determination of the appropriate beta. 1. The WACC of the company making the investment should be used in project appraisal. The WACC, that is, WACC is weighted average cost of capital. The WACC of the company making the investment should be used in the project appraisal. The WACC of the company making the investment should be used in the project appraisal, that is, the WACC of the investor, or should be used. I want you to take note that your WACC is the composite cost of capital, which comprises the cost of equity. WACC comprises the cost of equity and cost of debt. Cost of equity and cost of debt together will give you the WACC. And remember, our focus under this topic is risk. And I've told you that if you have watched my lecture under capital asset pricing model, where risk is involved, you are expected to use the capital asset pricing model formula in estimating the cost of equity. And the cost of equity is risk-free rate plus the beta into market return minus the risk-free rate. That is the formula for estimating the cost of equity under capital asset pricing model. The cost of debt, so if you have watched my lectures on cost of debt, then you'll be able to get how to calculate the cost of debt. The process of degearing, I want you to take note. Step 2, the process of degearing is not required if the business is not going to invest in a different project with business risk different from the risk of its current operation. You don't need to degear or regear if the business is not going to invest in a different project with business risk different from the risk of its current operation. So, step 2. Let's assume you have company A. Company A. Company A. I want to take company A to mean the company making the investment. Company making the investment. That is company A. Then we also have company B. Company B. Company B. Company B. Company B is the proxy company. Proxy company. Company B is the proxy company. That is, company operating in the business area of the project. Company operating in the business area of the project. That is what we mean by the proxy company. Supposing you have company A. Company A is the company making the investment, that is the investor. While company B is the proxy company, that is company operating in the business area of the project. I want you to be following me. Since the risk of the business area of the project, the risk here of this business, the risk of the business area of the project, and the risk of the company making the investment, that is the risk of company B and the risk of company A. The risk of the company making the investment may not be the same, since they are of different risk. They are of different business risk. The business risk of proxy company is different from the business risk of the investor. So, since they are of different business risk, so you will need the asset beta of the proxy company. You will need the asset beta of the proxy company. Remember, asset beta is the beta that reflects the risk of the business area of this company. So the only thing you need from the proxy company is the asset beta. Apart from that asset beta, you don't need anything from that proxy company again. So you only need the asset beta. To obtain the asset beta, if you are given the equity beta, I've told you that equity beta is for a geared company. So we need to remove the debt element from it by degearing the equity beta. When you degear the equity beta, then you get the asset beta. So you will need the asset beta of company B, since the risk in the business area of company B is different from the risk in the business area of company A. So I've told you what you need from company B, that is the proxy company, is the asset beta. So this asset beta, since company A and company B have different risk, you will need the asset beta of company B, which reflect the correct systematic risk, of the business area that the project relate. It is the asset beta that reflect the correct systematic risk of company B. If not given, you will need to degear the given equity beta. That is, if you are not given the asset beta of company B, then you will need to degear it. I told you that company B is the proxy company. You will need to degear the proxy company of the company. You will need to degear the proxy company to obtain the asset beta. So to degear the proxy company, the formula for calculating or estimating the asset beta is beta of asset equals to beta of equity times market value of equity over the market value of equity plus market value of debt post tax plus beta of debt times market value of debt post tax over value of debt or value of equity plus value of debt post tax. So to degear the proxy company, that is, you want to calculate the asset beta, then you make use of this formula. So take note of that. But debt may be assumed to be risk-free. So where debt beta of debt, where it is risk-free, that means the debt beta of debt will be assumed to be 0 where it is risk-free. So you always assume it is risk-free where it is not given, because it is close to 0. So but where it is given, you are going to use the full formula. But where beta of debt is not given, then you take this to be 0. If beta of debt is 0 multiplied by all these parameters, then everything here becomes 0. Then that means you'll be left with this. So the beta of asset now will now be equals to beta of equity times value of equity over value of equity plus value of debt post tax. So if beta of debt equal to 0, so the formula becomes this. So beta of asset equal to this. Please take note of that. Step 3. I've told you earlier that company B is the proxy company. I've told you that the proxy company is the company in the business area of the project. Proxy company is the company in the business area of the project. So step 3. Step 3. Remember, company B is the proxy company, that is company in the business area of the project. Where there are more than one proxy companies, where you now have more than one proxy companies, that is, you have more than one company in the business area of the project, you will need to obtain the asset beta of the individual company. You will need to obtain the asset beta of the individual proxy company. Then after obtaining that, then you calculate the simple average asset beta of all the proxy companies. I've told you that, let us say you have company A1, let me say you have company A, company B, company C, and company D. or let me say company 1, 2, 3, 4. 1, 2, 3, 4. These are the companies in the business area in which the project relates. All these 4 companies are the project companies. Then I said you will degear each of the project companies. By degearing each of the company or each of the project companies, that means you calculate the asset beta of the individual project companies. After calculating the asset beta, then you calculate the simple average asset beta of all the companies. Then that means you are going to have beta of asset of company 1 plus beta of asset of company 2 plus beta of asset of company 3 plus beta of asset of company 4. You add the asset beta of all the 4 companies, then divided by 1, 2, 3, 4. Since you have 4 companies, so you divide it by 4. That will give you the asset beta. Then after obtaining the asset beta, then step 4. Step 4. Then you regear the asset beta. Regear the what? The asset beta. Regear the asset beta obtained above. Asset beta obtained above. You now regear it. You obtain the you reject the asset beta to convert it to an equity beta based on the gearing levels of the company undertaking the project. That is based on the gearing level of company A. I've told you that company A is assumed to be the company undertaking the project. So you reject it in order to get the equity beta of company A. That is, of the company undertaking the project. You may use the same asset beta formula. The same asset beta formula we have explained may be used, except that the value of equity and the value of debt will relate to the company making the investment. The value of equity and the value of debt, when you are regearing it, it will relate to the company making the investment. So you may use the asset beta formula. So this asset beta formula, you may use it, or you may use this one, this asset beta, in order to get the equity beta. So beta of equity now will be equal to beta of asset plus beta of asset minus beta of debt, then to value of debt over value of equity multiplied by the tax. No, value of the debt must be post tax, so multiply by 1 minus tax rate. So that is step 4. Step 5, use the regear beta. Use the regear beta. Note this one, when you regear, so you get the beta of equity. So you now use the regear beta to find the cost of equity. Use the regear beta to find the cost of equity in capital asset pricing model formula. So in capital asset pricing model formula, so remember the capital asset pricing model, we have cost of equity equal to risk-free rate plus beta into market return minus risk-free rate. So that is the formula for finding the cost of equity. This formula will only give you the cost of equity. The beta is what you have obtained above. So you use it in this formula. That will give you the cost of equity. Remember, RF is the risk-free rate. This is the beta as obtained. Then RM is the average return on the market. Then RM minus RF is equity risk premium or average market risk premium. For better understanding, go over my lectures on capital asset pricing model. Step 6. Step 6. Then remember, you have only calculated the risk adjusted cost of equity. From this formula, you have only calculated the risk adjusted cost of equity. So you will need to combine it with the cost of debt to obtain the risk adjusted WACC. So what you will need is the WACC. So you will need to combine it with the cost of debt in order to obtain the weighted average cost of capital. So know the weighted average cost of capital. We need to have capital structure, which comprises equity and debt. Capital structure, which comprises equity and debt. Then we used to have the market value of equity and the market value of debt. We have cost of capital, the cost of equity, the cost of debt, whatever percentage you have. Let's say 8%. Then this is B%. So you now have hash total. So your hash total, this the product of this and this. Then this times this. So you add up the hash total column, you add up the total market value. So now to compute the WACC now, WACC will now be hash total. It will be hash total over total market value. Total market value times 100. That is the weighted average cost of capital. So that is the steps you need to take. So I want to solve a question as work example. This question is obtained from Capita Practice and Revision Kit, ACCA, Financial Management. Capita Kit, Financial Management. So you were told the equity beta of FENSCO is 0.9. The equity beta of FENSCO is 0.9. And the company has issued 10 million ordinary shares. The company has issued 10 million ordinary shares. The market value of each ordinary share is $7.50. The market value of each ordinary share is $7.50. The company is also financed by 7% bonds. The company is also financed by 7% bonds with a nominal value of $100 per bond. With a nominal value of $100 per bond, which will be redeemed in 7 years' time at nominal value. Which will be redeemed in 7 years' time at nominal value. The bonds have a total nominal value of 14 million. The bonds have a total nominal value of 14 million. Interest on the bonds has just been paid. Interest on the bonds has just been paid. And the current market value of each bond is $107.14. FENSCO plans to invest in a project that is different to its existing business operations and has identified a company in the same business area as the project, HESCO. That is to show that HESCO is a proxy company. Proxy. So now to determine the cost of capital, HESCO, we say HESCO is a proxy company. Then that means we need to degear the HESCO, since it is HESCO that is in the business area of the project. The equity beta of HESCO is 1.2. I've told you that when you degear the equity beta, then you obtain the asset beta. Asset beta is the beta that reflects the correct systematic risk of this business area. Then when you obtain the asset beta, then you can now regear to obtain the equity beta of FENSCO. So before you can calculate the cost of capital of FENSCO. So the cost of capital you need for the project is that of FENSCO, not that of HESCO. HESCO is only the business you were told operating and has identified a company in the same business area as the project HESCO. So that is why we say HESCO is the project company. The equity beta of HESCO is 1.2 and the company has an equity market value of $54 million. The market value $54 million. The market value of the debt, the market value of the debt of HESCO is 12 million. This is the market value of debt of HESCO. That is the market value of debt of the project company. The risk-free rate of return is 4%. The risk-free rate of return is 4% per year. And the average return on the market is 11% per year. Both companies pay corporation tax at a rate of 20% per year. Both companies pay a corporation tax at the rate of 20% per year. Now, required. A. Calculate the current weighted average cost of capital of HESCO. The current one, that of HESCO, is what is required. Not the weighted average cost of capital to use for the project. No, you need the WACC of HESCO to evaluate the project, to evaluate the viability of that investment project. But you will need the risk of HESCO. You know, HESCO has been identified to be the project company. So the only thing you need or you needed from the project company is the asset beta of the project company. Apart from the asset beta of the project company, you don't need other parameter from the project company. I've told you that where the asset beta of the project company is not given, then you will need to degear the project company in order to obtain the asset beta of the project company. I've told you that apart from the asset beta of the project company, you don't need the other parameters. B. Calculate a cost of equity which could be used in appraising the new project. The cost of equity that will be used to appraise the new project. So it is in B that you will need to degear the project company, that is HESCO. But in A, you have to calculate the current WACC, current weighted average cost of capital of HESCO. So that means you will need the equity beta of HESCO. You don't need the process of degearing or regearing in A aspect of the question. Now let's solve. Solution. So now let's go through the question. The equity beta of HESCO is 0.9. You have been given the equity beta of HESCO, beta of equity to be 0.9. Beta of equity of HESCO. So we are solving the A aspect. HESCO. So beta of equity of HESCO is 0.9. And the company has issued 10 million ordinary shares. The market value of each ordinary shares is 7.5. You know what you have to calculate is the weighted average cost of capital. In A, you have to calculate the current weighted average cost of capital. I've told you that to calculate the weighted average cost of capital, you will need the composite cost of capital. That means you will need to estimate the cost of equity and the cost of debt. To obtain the cost of equity now, since we are given the risk, the beta, which we use to measure the systematic risk, then that means you will need to apply the capital asset pricing model to calculate the cost of equity, which is the risk-free rate plus the beta into market return minus the risk-free rate. So you have known your beta to be 0.9, then you will need the risk-free rate and you will equally need the market returns of HESCO. Now back to the question. You were told the company is also financed by 7% bonds. This is a debt with a nominal value of $100 per bond, which will be redeemed in 7 years' time. at a nominal value. The bonds have a total nominal value of 14 million. Interest on the bonds has just been paid, and the current market value of each bond is 107.14. Fesco is planned to invest in a project that is different to its existing business operations and has identified a company in the same business area as the project, Fesco. That is why we say Fesco is the project company, because it's Fesco that is in the same business area with the project. The equity beta of Fesco is 1.2. You don't need the equity beta in A, and the company has an equity market value of $54 million. The market value of the debt of Fesco is 12 million. The risk-free rate of return, you are given the risk-free rate of return is 4% per year. That means our RF is 4%, and the average returns on the market is 11%. So our risk-free rate RF is 4%, while RM is 11%. So you can substitute into this formula, our capital asset pricing model formula, in order to obtain the cost of equity. So cost of equity now will be, our RF is 4% as identified, 4 plus the beta, which is 0.9, multiplied by RM, which is 11%, minus RF, which is 4. So if you have this will be 4 plus 11 minus 4, that will be 11 minus 4, that will be 7. 7 times 0.9, then we have 6.3. 4 plus 6.3, therefore cost of equity will be 10.3%. 10.3%. We've obtained the cost of equity. Remember, the Fesco is financed by both equity, with both equity and debt. So you will need to estimate the cost of the debt as well. So we have estimated the cost of equity. So we need the cost of the debt, and the debt is bonds. So now let's estimate the cost of the bonds now. So now I've told you that if you watch my lectures on cost of capital, I said to estimate the cost of debt, the first thing is to identify the types of debt. Now let's go through the question in order to identify the type of debt, so that we'll be able to know the approach to use. So the bonds, the company is also financed. The company is also financed by 7% bonds with a nominal value of $100 per bond, which will be redeemed in 7 years' time. That means it is a redeemable bonds. Since this is a redeemable bonds, I've told you that to estimate the cost of a redeemable bonds, you are going to make use of the internal rate of returns, IRR. So I've told you that for the purpose of IRR, the market value will be used in year 0. The interest, annual interest will be paid, will be used as annual cash flows. Then we can also compute the tax relief on interest. Then we can also have the repayment value, which will be treated as an inflow at the end of the project. So at the end of the life of that project. Now, for our purpose now, we want to estimate the cost of a redeemable bonds. So we have year, then the items involved, items. Then we can have cash flows. Year 0, I said that will be the market value. And how much is the market value of the redeemable bonds? Now let's go through the question in order to identify the market value of the bonds. So the company is also financed by 7% bonds. It's also financed. The company is also financed by 7% bonds with a nominal value of 100. This is the nominal value per bond, which will be redeemed in 7 years' time. At a nominal value. The life of the project is 7 years. At the nominal value, it will be redeemed at the nominal value. That means it will be redeemed at par. and the par value is 100. That means that will be treated as an inflow in year 7. The par value, since it will be redeemed at nominal value. At par, the bonds have a total nominal values of 14 million. The 14 million is the total nominal value of the bonds. 14 million is the total nominal value. Interest on the bond has just been paid. Since the interest has just been paid, that is to show that the market value is X interest. The interest has just been paid. That is to show that the market value is X interest. And the current market value of each bond is 107.14. 107.14. I've told you that the market value will be treated as an inflow in year 0. So 107.14 as an inflow. As an outflow in year 0. The market value 107.14 as an outflow in year 0. Then we now have annual interest from year 1 to 7. Year 1 to 7. So we have interest. Interest. The rate of interest is given to be 7%. 7%. That is the interest rate. That is 7%. The company is also financed by 7% bonds. So we use the coupon rate of the bonds. And the coupon rate is 7%. 7%. Then same year 1 to 7. You have tax relief. Tax relief on interest. Tax relief on interest. You are going to make use of the tax rate in order to calculate the tax relief on interest. And you are given the tax rate to be 20%. You were told, and the average return on the market is 11% per year. Both companies pay corporation tax at a rate of 20% per year. They pay corporation tax at the rate of 20%. So, to compute that tax, you calculate 20% of interest rate. What is 20% of 7? 20% of 7, that gives us 1.4. 1.4. You treat that as an outflow. Outflow year 1 to 7. Outflow. At the end of the project life, which is 7 years, the year 7, you have the repayment value. How much will be redeemed or repaid? Repayment value. How much will be repaid? You were told it will be redeemable at par. Now the par value is 100. Debt is always denominated into 100 as their par value. Then you want to compute the IRR. Let's try discount factor. You are going to use trial and error method. Let's try 5% discount factor at 5%. So year 0 will only be 1. Now, since it is cumulative, year 1 to 7 you need. Year 1 to 7, you are going to make use of the annuity formula, which is 1 minus 1 plus R raised to power minus N over R. So for better understanding, please try to watch my lectures on cost of capital. Cost of capital part 2. So I deal with all types of bonds: redeemable, irredeemable, convertible, preference shares in part 2. And part 1 covers the cost of equity. Then I also have the weighted average cost of capital treated in another lecture. So before I equally examine the capital asset pricing model in another lecture, please try to watch all my lectures for better understanding. So now let me use of this formula. Our R is 5%. So we've assumed 5% as our discount factor. 5%. So that means you substitute 5% for R. Our N is the number of period, which is 7 years. So for 5% now, so we have 1.05 raised to power minus 7 years, yes, minus 1 divided by 0.05. Then we have 5.786. 5.786. Now the R is 5, N is 7, R is 5. So we have 5.786. So you can put can substitute there. 5.786. 5.786. Then in year 7, in the 7th year, year 7 alone, so you make use of 1 plus r raised to power minus n, where r is 5%, our n is 7. So to obtain the discount factor for the 7th year, 1.05 raised to power minus 7. Then we have 0.711. 0.711. So 0.711. So then you calculate the present value of that. Present value at 5% cost of capital. You know the cost of capital we use is 5%. So 107.14 times 1 will be 107.14. 107.14 negative. Then 7 times 5.7 times 5.786. Then that gives us 40.502. 502. Then 1.4 minus 1.4 times 5.786. 1.4 times 5.786. Then we have 8.1004. Then 100 times 100 times 0.711. Then we have 71.1. 71.1. Then what will be the NPV of that? NPV, the net present value. You sum it up. 71.71 minus 8.1004 plus 40.502 minus 107.14. Then we have minus 3.63 minus 3.6384 negative. Since that is negative, our first NPV was negative, then you will need another NPV that will be positive. No, for the purpose of internal rates of return, two net present value must be calculated. One must be positive and the other one must be negative. So now let's try, since this is negative, to get the positive one, you try another rate that is lower than what we have used previously. We've used 5% and we got negative. So let's try 3%. Discount factor at 3%. Year 1, year 0 will always be 1. Now, you need year 1 to 7. So the same formula will still be used. Same formula will be used. Remember, our R becomes 3%, N remains 7. So we have 1.03 raised to power minus 7 minus 1 divided by 0.03. Then we have 6.23. 6.2330. 6.230. So that is at 3%. So that gives us that. So then same for this year, since it is the same year 1 to 7. So we have 6.230. Why for the year 70 alone, you make use of this second formula, 3%, 1.03 raised to power minus 7. Then we have 0.711. 813. Now, you need the present value when the discount factor is 3%. So 107.14 times 1 will still be 107.14. Then 7 times 6.230. 6.230 times 7. Then we have 43.61. Then 1.4 times 6.230. 1.4 times 6.230 minus 1.4 times 6.230. Then we have minus 8.722. Then 100 times 0.813. Then that gives us 81.3. So you sum it up. So when you sum it up, so we have minus this 8.722 plus 43.61, then minus 107.14. So we have positive 9.048. This one is positive. Now, since we have got two NPV, one positive and the other one is negative, then to compute, the next thing is to compute the IRR, the internal rate of returns. Internal rate of returns. So our IRR, the formula for calculating the internal rates of returns, we have IRR equals to lower rate plus NPV, net present value at that lower rate, over net present value at the lower rate minus net present value at higher rate into higher rate minus the lower rate. And our lower rate is 3%. The lower rate from our IRR computation is 3% plus. So when the rate is 3%, we got positive NPV of 9.048. 9.048. So we have 9.048 over the NPV at lower rate, 9.048 minus NPV at higher rate. NPV at higher rate is negative, and we got 3.6384, which is negative, minus 3.6384 into higher rate. Our higher rate is 5% and the lower rate is 3%. So this will be 3 plus this 9.4048 times 5 minus 3 will be 2 over this minus and minus become plus. When you sum up the denominator, 9.048 plus 3.6384, then we have 12.6864. Now we have 9.048 times 2 divided by 12.6864. Then this is 3 plus this will give us 1.43. When you sum it up, you have 4.43. approximately. That is our IRR. We've got our internal rates of returns. The next thing is to compute the WACC. You want to compute the weighted average cost of capital. So, and for the purpose of WACC, that is your weighted average cost of capital, we used to have capital structure. Capital structure, which comprises equity and debt. Then we have the market value. How much is the market value? Then we also have the cost of capital. The cost of equity has been calculated and we got 10.3%. 10.3% as our cost of equity, 10.3% as the cost of equity. The cost of debt as calculated, we got 4.4%. Now, having calculated our cost of equity and the cost of capital of debt, now you want to calculate what is the total market value of the firm. So the total market value of FENCO, back to the question, in order to identify that. So how much is the market value? And how many ordinary shares has the company or FENCO? The equity beta of FENCO is this, and the company has EU 10 million ordinary shares. The market value of each ordinary shares is 7.5. So the market value of FENCO ordinary share, market value, that of ordinary share, since FENCO is having 10 million ordinary share, times, and you are given the market value per FENCO share to be 7.5. So ordinary shares is, the market value is 7.5. The market value of each ordinary share is 7.5. So 10 million times 7.5, that will give us 10 million times 7.5, then you have 75 million. So the market value of ordinary shares of FENCO is $75 million. And that of bonds, how much is the market value of bonds? And how many bonds has FENCO? So go back to the question. The company is also financed by 7% bonds with a nominal value of $100 per bond, which will be redeemed in 7 years' time at a nominal value. The bond have a total nominal value of 40 million. The nominal value is 40 million. Interest on the bonds has just been paid, and the current market value of each bond is 107.14. The nominal value of bonds is 14 million, and the market value per bonds is 107.14. So what will be the market value now? The nominal value has been given to be 14 million. And bonds is always denominated into hundreds. So 14 million divided by 14 million divided by 100. 14 million divided by 100 times the market value per bonds, which is 107.14. And this will give you the market value of the bonds. So 14 million divided by 100 times 107.14. So the market value of the bonds is 14.9996 million. Now, you go back to working the calculations of WACC. The calculation of WACC, the market value of ordinary share has been calculated to be 75 million. Then you put that under the market value of equity or ordinary shares, $75 million. The market value of debt, which is the bonds, and it has equally been calculated to be 14.9996 million. So 14.9996 million. What is now the total market value? So you add the market value of equity and the market value of the bonds. Then the total market value is 89.9996. 89.9996. Now, the next column you have hash total. Hash total. To get the hash total, you have 10.3% of 75 million. 75 million times 10.3%. That gives us 7.725 million. Then 14.9996 million times 4.4%. That gives us 0.6599824. So the total of the hash total, if you sum up this and this, plus 7.725, then you have 8.3849824. So now you compute your WACC, weighted average cost of capital, which will be the hash total of 8.3849824 over the total market value of 89.9996 times 100. So when you divide that, divided by 89.9996 times 100. Therefore, our weighted average cost of capital is approximately equals to, WACC is approximately equal to 9.3%. Our WACC is 9.3%. That is all about the requirement A. Now, the requirement B. You are to calculate the cost. Calculate the cost of equity, which could be used. Calculate the cost of equity, which could be used in appraising the new project. The cost of equity, which could be used in appraising the new project. That is the requirement B. Now, since it is the cost of equity that will be appropriate in appraising the new project, you will need to ungear the project company. It is then that the information about the investment will be relevant. So you will need to ungear the project company by calculating the beta of assets of the project company. Now, you will need the beta of assets of the project company. That is requirement B. Beta of asset now equal to beta of equity times value of equity over value of equity plus value of debt post tax. I've told you that of beta of debt times value of debt post tax over value of equity plus value of debt post tax. And I've told you that debt may be assumed to be risk-free. If debt is risk-free, that means beta of debt equal to 0. If beta of debt is 0, that means the formula becomes beta of asset equal to beta of equity times value of equity over value of equity plus value of debt post tax. Now, This formula should be used. So now that we want to ungear the proxy company or degear, we either call it degear or ungear. Let's say degear the proxy company, and the proxy company is HESCO. HESCO. So we want to degear the proxy company in order to obtain the asset beta of the proxy company. I've told you that the only information you need from the proxy company is their asset beta. Now let's go back to where we have information about the proxy company. You were told that FESCO plans to invest in a project that is different to its existing business operations and has identified a company in the same business area as the project, HESCO. That means HESCO is the proxy company. The equity beta of HESCO is 1.2. Beta of equity. We do not need the beta of equity of HESCO. What we need from HESCO is beta of asset. And you are given the equity beta to be 1.2. Then, and the company has an equity market value of 54 million. The market value of HESCO is 54 million. So we have market value of equity, value of equity to be 54 million. $54 million. And the market value of the debt of HESCO is 12 million. That is the market value of the debt. So market value of the debt of HESCO. Now value of debt is given to be $12 million. Now to ungear the HESCO, now you substitute into this formula in order to obtain the asset beta. So the beta of asset, we say it is equal to the beta of equity, and the beta of equity is 1.2. 1.2 times value of equity. The market value of equity is 54 million. 54 million over value of equity 54 million plus the value of debt is 12 million minus 12 million. Value of debt is 12 million into 1 minus tax. 1 minus. Our tax rate is given to be 20%. Tax rate is 20%. You are given 20% tax rate. That you were told that both companies pay corporation tax at the rate of 20%. So the tax rate is 20%, which is 0.2. 0.2. So then 1.2 times 54, 1.2 times 54, then we have 64.8 over, if you subtract 1 minus 0.2 will be 0.8. 0.8. So 0.8 times 12, then we have 9.6. 9.6 plus 54 plus 54, then we have 63.6. So beta of asset now, beta of asset will be 64.8. 64.8 divided by 63.6, and that gives us 1.019 approximately. 1.019. That is the asset beta of the proxy company. Now that we've obtained the asset beta, then you now regear to obtain the equity beta of FESCO. Now let's regear. Regear, you know, FESCO is geared. So what you will need, the beta to use in your project appraisal for FESCO, since FESCO is geared, so should be the equity beta. So regear the asset beta of HESCO. Remember, HESCO is the proxy company of HESCO to obtain the equity beta of FENSCO. To obtain the equity beta of FENSCO. So you may use the same formula, or you use the formula I've given to you earlier, that the beta of equity equals to beta of asset plus beta of asset minus beta of debt, value of debt over value of equity, and your debt must be post-tax. So you may make use of that, or you use the same formula as above, only that you want to make your beta of equity the subject of the formula, since you have obtained the beta of asset. So the beta of asset as obtained is 1.019 as obtained, plus the asset beta remain as 1.019 minus beta of debt is 0. And what is the market value of debt and the market value of equity of FENSCO? You go back to where you were given the information. Okay, we've obtained the market value of debt and equity of FENSCO the other time in A aspect. The market value of equity of FENSCO is 75, while the market value of debt of FENSCO is 14.9996. So market value of debt is 14.9996 over that of equity is 75 into 1 minus tax rate, which is 20%. So now 14.9996 times 1 minus 0.2 will be 0.8 times 0.8 14.9996 times 0.8 times 1.019 times divided by 75. So when you add 1.019, everything will give you 1.182. So beta of equity is 1.182. That is for FENSCO. Let me reconfirm that. 14.9996 times 0.8. This one will give us 0.8. Then this minus 0 will still be 1 point times 1.019 divided by 75. Then plus 1.019. Then we have 1.182. That is the equity beta. Now that we have obtained the equity beta of FENSCO, then you now substitute for the equity beta of FENSCO in the formula, in our capital asset pricing model formula, in order to obtain the cost of equity. So the cost of equity now of FENSCO, cost of equity of FENSCO will be using the capital asset pricing model, risk-free rate plus beta into market return minus risk-free rate. So you are given same risk-free rate as of before, which is 4%. The risk-free rate of return is 4% per year, and the average return on the market is 11%. So the risk-free rate remains 4, and the market return, risk-free rate 4%. Our beta is as calculated, which is 1.182. The market return is 11 minus risk-free rate, which is 4. So we have 4 plus. So 11 minus 4, that will be 7. 7 times 1.182. Then when you add, that will give us 8.3. So we have 4 plus 8.3. When you add it, you have 12.3%. That is the cost of equity. So 12.3%. And what you have to calculate is, you have to calculate a cost of equity which could be used in appraising the new project. You are not to compute the WACC in B. What you have to compute is the cost of equity. That is all about that. Please, once again, if you are a returning subscriber, I say thank you. But if you have not subscribed previously, please don't forget to subscribe. Click on the red subscribe button, and beside it, you will see the bell notification icon. Go ahead to click it so that you'll be notified each time I drop a new video. Thanks.